With the election results officially in, the markets are screaming for risk on, but with a nasty little twist. Let's not forget about that sneaky Fed meeting tomorrow where Jerome Powell will have to address the bond market, which is imploding before his very eyes. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily time frame chart, and let's just start with the elephant in the room. Of course, there was a massive gap up with the election results coming out last night. The market responded favorably. It opened at brand new record highs in the S&P 500. As you can see based on the lower wick of today's daily bar, we did come in to retest the previous all-time high. Buyers responded, were able to take back out the opening print and close near the high of today's session. Once again, a very, very bullish session here, going on to produce new higher highs in the trend count, which is very important because technically speaking, we were coming from a lower low in the trend count, and the risk outside of the election gap up prior to sort of dealing with these fundamental catalysts was that we could even just close this gap from Thursday of last week, yield a lower high, and continue a potential downtrend here. Obviously, that's not the case, and the trend has promptly changed back in the upward direction. If you check out the tweet on the screen right now, one of the things we said is that this risk existed. However, we'd be very quick to change our tone if the trend flipped back to up. This is me raising my hand and saying, hey, we're promptly changing tone. Everything's back to being bullish from a trend perspective here in the market. So what are the ideal plays here going forward? Of course, any consolidation that remains over the previous all-time high just looks for continuation in the upward direction. I would remind you folks that from a weekly and monthly perspective, we do have a measured move from a bull flag up here at 610. I'm not arguing that we go there in the next 2 trading days to end out the week. I'm just pointing out that it's a next overhead target as we're moving into blue sky territories. If the pullback gets a little bit deeper and if the market does decide to close some more of this gap, one of the things I would pay attention to is the bottom end of this consolidation range right here, which is still at 579.75. This was a key level that we talked about in the weekend update. It was the potential for a lower high, of course, as we were just making note. Now that we're above that on a gap up via this move that happened on today's session, it can potentially act as support, and I would honestly start thinking of that as a line in the sand. It's not going to be the line in the sand. You can still see that I have not adjusted my line in the sand here at 574.40, because if you technically want to play devil's advocate, what could happen, right? Technically, this gap could close all the way. You could find buyers in this area, and technically speaking, from here to here, you would have a higher low in the trend count. In a picture perfect world, you would just get bullish consolidation and continuation or some sort of mild pullback that would suggest buyers step up here and then a Brigade bolt back over the previous all-time high. Really, it's a zone here. 584.65 up to 586 is the level. If we can get back above this zone, that's where you could also initiate new long trades in the upward direction. If this gap does not close all the way, what does it tell you about the participants in the market? We really do not have stronger sellers getting active at this time. One of the very clear ways that we can just delineate between risk on and risk off. As of right now, the daily chart is incredibly bullish. Let's take a look at the hourly time frame chart and see what's going on from this perspective. Once again, let's acknowledge the massive gap up that happened over here. We open on this gap up. Technically, there is an opening drive to the downside. The sellers do have their opportunity there, but where do we find support? A very logical area here on the both daily chart that we were looking at as well as the hourly chart, right? Previous all-time high, as well as the shelf of previous resistance just a little bit underneath at, once again, 584.65. Buyers find support there. Then they go on to take out the opening print and produce new highs into the afternoon. If we had stronger sellers active in this market, they should have attempted to find a lower high underneath and go for more of a gap close into the end of today's session. It simply did not take place. So as we walk forward, buyers are in the driver's seat. You could even make reference to today's opening print around 589.25. You guys know the rules up here in the penthouse. Round numbers only. Let's adjust this quickly together. An even more mild pullback. And again, I'm not saying that it has to happen this way, but something that looks like this is also a reasonable long setup where we can at least manage risk and trade back into the all-time high, if not blue sky territories, to balloon some runners in the upward direction. So what does that leave the sellers? Are there any short opportunities here into the end of the week? I mean, sure. If we do see a move underneath this zone, as we had just called out, out at 584.65. Some sort of lower high that's set in here can come back in and try to close some more of this gap towards the 579.75. It's just that when we get to this level right here, which you can clearly see on the hourly chart now, I would certainly be putting my thinking cap on and saying, is it possible that the daily time frame chart could spot buyers here, reverse the hourly trend, and then move back in the upward direction? I think the answer to that question is absolutely. We can quickly throw on the anchored view apps, not that there's really going to be much to say about this. We're above the entire cluster. I have started 2 new anchors from this to the downside. The other thing that's coming to mind now that I'm looking at these anchored view apps is just that, like Tesla, this is now an island reversal off the lows, right? There was a gap down to set this, now this massive gap up to the upside. Anybody who's trapped short from down here is absolutely getting pinched out of this market, and the pressure is on. I would say right now, the buyers absolutely have the upper hand based on everything that we can see in the charts in front of us. So key levels one more time as we move along. 589.25 is the best higher low pullback intraday for moves in the upward direction. If we pull back further and test again 584.65, I would still be looking for buyers there. If we spot a lower high underneath, short sellers can act intraday for pullbacks to 579.75, where I would promptly change my tone and just look out for a reversal off of that level. Remember, daily high or low. If we do close the gap, although I don't want this to happen, it technically could be a daily higher low still that we were just exploring on that previous chart. Let's move along to the market internals here and see what else is going on. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Generally speaking, the market had almost anticipated what was going to happen overnight the day prior. If you look at the bullish inflows of volume on Tuesday, if you look at the advanced decline line in trend higher zone by the time the day closed, if you look at the big 45-degree build here out of the cumulative tick, we did have a solid trending day on that Tuesday session. Strong opening drive with continuation into the afternoon, high and tight consolidation, and the rest is history through the overnight session. So generally speaking, the move higher here is being supported at the market, or I should say the exchange level on the NYSE, right? And we'll see this in the NASDAQ as well, even the Russell 2000. On today's session during the gap up, I will just point out that honestly, the volume flows net were solid, but the actual intraday ratios of up to down volume were not all that impressive. I think they topped out here around mid twos. As a matter of fact, if I just remove this, we can actually see it really quickly. Let's get rid of that, and let's take a closer look at, during today's session, you can see in the back half of the session, we were just scratching at 2-to-1 on the actual ratio, so not as strong as the Tuesday rally earlier on in the session happening here. You can see much stronger breath reads from a ratio perspective during that morning session and into the afternoon. Regardless, it still supports the thesis that new money buyers are getting active in the market, and we do not have any signs of stronger sellers at this present moment. If you look at the advanced decline line, positive here, strong day on Tuesday, and on today's session, not the strongest show of strength in trend higher zone, especially given the magnitude of the gap up, but still positive nonetheless. Strong builds on the intraday index score on both the Tuesday and Wednesday session today. I will point out that the tick cumulatively was a little bit weak on today's session. You had much more two-sided activity back and forth through the zero line here, which is again totally reasonable after a nearly, in the ES futures, 120-point gap up. That's absolutely monstrous. I'm honestly surprised that the market was even able to trend into the afternoon. I was really expecting after the opening was a little bit more lackluster, some of that sort of sideways pressure to build as we had the 4 different cohorts of buyers and sellers getting involved, right? You have new money buyers putting long pressure into the market, old money buyers taking profit, putting short pressure into the market. You have new money shorts putting short pressure into the market, and old money shorts saying, oh my goodness, I cannot bear the thought of being short this market on the gap up. Closing out provides long side pressure, upside pressure to the market. So it's really expecting more of a sideways day. It was really this afternoon rally that turned into a bonus, if anything. It's not. It was really not on my bingo card, if you will, for a stronger end-of-day rally, but we got it nonetheless. Once again, really reinforcing the fact that we have a definitely bullish and risk-on market on our hands. Let's quickly jump on over to the market profile. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. It just goes alongside with all the analysis we've conducted so far. You can clearly see the value area and point of control migrate higher on the Tuesday session when we had that strong trend day intraday. Here's, of course, that monster overnight session through the night of the election. And you can see on today's session, the value area and point of control are absolutely higher with price. They did not get stuck down here towards the lows of that A period session. Heck, even B, C, and D have some overlap down there. Another small call out on the market profile is just that we do have a poor high. Technically, it could use some repair, just meaning that it wouldn't be unreasonable to sweep that and go on to produce a brand new all-time high. What we want to see if a new all-time high is going to set and stick ultimately, if you want to see a deeper pullback, you need to see an excess high here. This is not not an excess high. So the rally, the auction, has technically ended improperly near the highs. We would want to see that repaired, aka further upside. Let's jump on over to the QQQ NASDAQ 100 and see what's going on from this perspective. We'll reset to a daily chart. And the beauty of today's analysis, whenever we're producing brand new highs like this, is that technically, I think we can get it done in a little bit quicker of a time frame. So here we go. Monster gap up, going on to print new highs as the intraday rallied to the upside. We did not gap up to those new highs, but we did gap up from an island reversal perspective, very similarly to the S&P 500 over these previous swing highs, but not quite the all-time high from back here. Obviously, the trend remains in the upward direction. One of the other nuances about the NASDAQ is that it really didn't fall into a downtrend here. You had one daily close underneath this line in the sand that we've mapped at 486. Then you sort of had multiple days kind of closing back in range, and this even getting back into the middle range, if you will, from back over here. So was there ever a point in time where the NASDAQ was more bearish and saying, like, oh my goodness, here we go, here's a downtrend? We never quite made it there in the NASDAQ. So to see this breaking in the upward direction once again is not as much of a surprise compared to the S&P 500. Honestly, in sort of a twisted world, if I were to think about what could have happened in an alternate universe, it's like the S&P gapped near the all-time high, but the NASDAQ outperformed, noting that it was displaying some relative strength without breaking down from this daily line in the sand. Obviously, that has not happened, and we'll speak about the chart in front of us. That's just an interesting take here. Regardless, what are the ideas as we move forward? Any consolidation over the previous all-time high is obviously looking for continuation higher. The weekly bull flag target here on the NASDAQ is up at 518. Again, just like the S&P 500, I'm not calling this for, into the end of the week, even next week, give or take, but over time, 518 is a level to pay attention to. If we come back down underneath the previous all-time high, I would not be thinking about shorts until we are starting to entertain the gap close underneath that is below 500 with a lower high, can close the gap into the bottom end of the midpoint range at 492.50. If I zoom in a little bit closer on this, we can get a little bit more of a cleaner picture of these outcomes. So once again, consolidation and continuation. I would be still on the bull side here, probably looking for the Brigade bolt back over 503.25. Heck, even the break of today's high of day gets interesting for new highs, and this is where the shorts come out to play, looking for a gap close from 500 down to 492.50. Here, I would certainly be thinking gap fill reversal can produce a daily higher low, right? You have lows, higher lows equal lows. In this instance right here, this absolutely could set the next frame or the next cluster of daily higher lows on this particular chart, keeping the trend in the upward direction, noting that we are technically pulling back from the highest high in the trend count, brand new all-time highs as well here in the NASDAQ 100. Let's take a look at the hourly time frame chart. What else can we learn here? Really not much to describe. I think that it's status quo, right? Consolidation, Brigade bolts higher. We all know what we just talked about on the daily. The only interesting thing to add into the analysis here is that if we were to come down and close the gap all the way, from a technical perspective, all the pattern traders would love to see a double bottom neckline retest. That is the gap close at 492.50. Another spot to certainly entertain higher lows from that daily time frame perspective. We'll quickly throw on the anchored view apps intraday, see if we can learn anything here. A little bit of confluence towards the 500 level, if there is sort of this consolidation or pullback here, would support the idea that buyers remain in control if we're over this breakout day, or maybe just rally day up to the neckline here from the Tuesday session in the NASDAQ. So 500 key area of potential support as and if the market pulls back. What I love about the intraday action today is that the all-time high prior was acting as intraday resistance. So if there is a pullback, again, structurally makes a lot of sense that 503.25 is going to be a top watch because of the intraday dance that was produced when testing as resistance from the bottom side up. Let's quickly take a look at the market internals for the NASDAQ side of things, and we'll see what's going on from this perspective. So huge volume inflows on Tuesday and today's Wednesday session. You'll notice that the advanced decline line is strong on Tuesday, decently strong on today's session as well, stronger than the S&P, I'll add. If you look at the cumulative tick out of the index down below, strong read there, as well as a flat read similar to the S&P on today's session. Once again, got a little bit better than expected rally into the afternoon. Was kind of expecting a bit more chop here after the opening range. Really decided to go more so sideways than anything else. One of the things that we would just continuously reinforce is that the sellers were unable to close the gap, right? That's a very, very important take here on the NASDAQ and the S&P 500. You'll note that, again, there was a decent pullback in that second hourly bar, but where did the chart go? It didn't go any lower than the opening print. Sellers were not there. They were not stepping up. This market is risk on. It is in the control of the buyers as of right now. So higher low pullbacks are the name of the game. Continuation out of this trend in the upward direction is the name of the game. Let's quickly be congruent and take a look at the NASDAQ market profile. If I do something that looks like this, Again, just making sure we can see a decent amount of price action here. Strong move in the upward direction, a little bit of single print action here to divide into a double distribution during H period, if I'm not mistaken. Yes, there we go. So double distribution, I would be watching very closely, and I will be watching tomorrow morning in the pre-market prep, very closely to determine whether or not the NASDAQ opens up in distribution number 1. That's going to be here. Over, the technical level is at 20,846. If you're over that, you're in the upper distribution. That's about as bullish as it gets for tomorrow's open. If you open in the lower distribution, which is underneath 20,828, then I wouldn't call it bearish, but I certainly would be more open-minded to consolidation in the NASDAQ. Notice that the point of control and the value area was technically lower in the NASDAQ compared to what we had just seen in the S&P 500. Not the end of the world. It's not a bearish call. It's just one small nuance to pay attention to. I would focus much more so on the double distribution here, and once again, roughly 20,840 as the dividing line, over or under. Let's go back on over to the platform here, and obviously, if you're looking at the cash equivalent levels, you're talking about 504.40. If you're above 504.40, you're in the upper distribution. If you're underneath that, underneath the previous all-time high, 503.25, you are in the lower distribution, slightly more bearish or indicative of just consolidation. Let me be careful with my words. It's not bearish. It's just more indicative of consolidation. This would be more representative of excess. Let's jump on over to the Russell 2000 and see what's going on from this perspective, because honestly, I'm thrilled more so to report on the Russell than the S&P and the NASDAQ. I mean, how long have we been stuck in this monthly balance right here? Ever since those sort of like June and July sort of breakouts here, and then the early August panic, right? That sort of established this monthly range, and we've been grinding to the upside. Like, we'll give credit where credit is due. The buyers have been trying to get this to turn into more of an ascending triangle than just a simple balance range, right? You could do something that looks like this. There you have it. But a strong break, finally, of this range in the upward direction from the small caps is another indication of a more risk-on environment, right? Obviously, operating conditions here, and a huge one with the election, of course, has to be regulation. With some of that deregulation possibly about to take place, it makes it easier for small caps to become profitable, obviously, produce things more easily. So with that sort of understanding for small caps, this bullish breakout does strike me as, generally speaking, for the S&P 500 as a whole, it's really supporting evidence of this more risk-on mentality after the results of last night. So this, I'm pleased to report on it. Big gap up, of course. Little bit of a gap close in the lower wick, clearly rallying back to the opening print, through the opening print to close strongly at the high of day for today's session. Even if there is a deeper pullback, a retest of this big breakout level would certainly be fine. You could think of this through the lens of a massive daily Brigade bolt looking for a higher low here over 227. That's still not even a full gap close. So keep that in mind. Let that sink in. If the market pulls back to retest this prior pivot high, which is basically the top end of the range, right? Then that's still not closing the gap all the way. If the buyers support over that, then it's just another clear-cut indication that sellers are not strong in this market. They're not active in this market, more of a risk-on indication. And again, if you're not a small-cap trader, carry this over to the sentiment in the S&P 500. With that sort of done, let's take a look at the hourly chart, which again, it really speaks for itself. Sellers could not really accelerate much further than this, rallied back into a previous and very historic level here, by the way. Just for some context, let's go out to a, 5-year chart, I think does it. Yeah, you can see back here, these levels, what we literally rallied and closed at today, 237.50, if I zoom back in over here, is the bottom end of this overhead supply, right? You could think of this as a bit of a lower high double top. There's your neckline. That's exactly where we stopped today. Anything beyond that, you're really just looking at the all-time high, right? That's up there at 244.46, going back on down to the daily or hourly time frame chart, and you consolidate. Again, just think about this through the lens of bullish nature, risk on nature. It doesn't mean that the market can't pull back. I want to be very clear about that. Obviously, there's a little bit of a, I'm catching it in my own voice as I'm going through the video today. There's a little bit of emotion, like, okay, here we go. It's looking like the market's ready to rock and roll. And I think the charts do support this. I don't think I'm speaking out of line here. But, markets have give and take. There can be some pullback. We've talked about key pullback levels. I think consolidation here is bullish. We get something that looks like this. It's rock and roll to the upside, targeting the all-time high. If we get something that looks like this, again, totally reasonable that you could trade some scalps on the short side underneath 232.75, today's low of day, into that 227 major area of daily support, the breakout level that we were just talking about on that daily chart. So generally speaking, keep it simple. There's your pathing for the small caps, and we know it's bullish pressure. How many times do I have to say that? Probably have said it too many times already in today's episode. Here we go. Here's the market internals. Market internals. Here's the VWAP, intraday anchored VWAP. I'm moving at 1,000,000 miles an hour. Here it is, support, confluence, right at the low of today's session, 232.75. Notice that this is right at 227. Literally couldn't have asked for anything better out of the, here we go, out of the, not market internals, anchored VWAPs. Goodness, it's like the words are sort of lost in my head. So anyways, there we have it. Perfect levels, perfect confluence, 232.75, 227, 224.25 is the gap close. Any of these areas act as potential support. Any straight up continuation over 237.50, as we just described, is going for the all-time highs in small caps, and you have to imagine it's a tailwind for the S&P 500. Let's jump on over to the Russell internals here, see what's going on from this perspective. As we can see, it's just a rinse and repeat of everything else. Bullish inflows, in-trend higher zone for the close, in-trend higher zone all day today. Stronger cumulative build on Tuesday, stronger cumulative build on Wednesday today for the Rusty Russell. Once again, more of a risk-on indication. If we take a look at the market profile for the Rusty Russell, let's see what's going on from this point of view. A little bit more of a balanced and normal-looking day here. However, point of control and the value area is generally higher in the individual session. Notice the poor high here, and another call out from the Rusty Russell in particular is that it did not go on to produce a new high over the overnight high. One of the things that we know about rallies, and this is not just true of all-time highs because this is not an all-time high in the Russell, but one thing that's true about rallies or auctions in general is that if the end of the auction is going to be proper, you need a euphoric high. You need an excess high. Excess highs are typically not found in the overnight session, so I would argue that this is weak and could be carried forward as something that is in need of repair along with the high of today's session. And as we know, that likely means we have bullish pressure trying to repair those auction highs, pressuring markets to new highs in this general sequence that we're in currently. So trends are up, bulls are winning across the board here after the results of the election. I do want to jump back on over to the platform here. And, you know, the other thing too is like we're in the business of making money. It doesn't matter who wins the election, who doesn't win the election, how you felt about it, how this, how that. We're in the business of making money. We're reading the charts in front of us. You know, the charts are suggesting that we have a risk-on environment. So I just want to make that very clear, right? We're in the business of making money and reading the tea leaves from this perspective. Here we go. If we take a look at the weekly performance of the S&P sectors, who is winning, who is losing, and where is the weight? XLF financials are leading the pack here, up 6.31% on the week. As we know, that's the second heaviest weighted sector by market cap. Absolutely stunning display of strength with the gap up to new highs on this morning's open. Very, very strong out of financials, another risk-on indication. Energy's up big time, up 5.56%. It's followed by industrials, 5.43%, discretionary up 5.1%, technology up 4.12%, semiconductors up 3.87%, right? Everything here has outperformed the index so far, and everything that we've just listed off is definitely a risk-on style sector, right? These are bullish indications for the market. At the bottom end of the barrel, it's the TLT bonds getting absolutely hammered, as we mentioned in the intro. The bond market's imploding in front of Jerome Powell's very eyes. We have consumer staples, which is a lighter weight risk-off sector, red on the week, down 88 basis points. And the real estate sector is getting, I wouldn't say pummeled, but it's down 65 basis points. And of course, that's due to the 10-year rate, which is absolutely exploding. And we'll talk more about that when we get to the fundamental take. Generally, the sector performance here is risk-on as we're producing new highs, record highs in the S&P 500. Zooming into the XLF, as we've just described, big gap up, nothing more to say other than consolidation, continuation, close the gap partially. Here's a Brigade bolt, nothing bearish to say. Let's try to keep it simple and quicker through the sectors. Energy, gap up, it gapped the gap, so technically you have an island reversal down here. As long as it's over 92, technically upside pressure for the S&P. I'd be slightly concerned about some inflationary pressures there, but if you go to the crude oil price as of sort of what's happened recently, this morning it was down a bit, but it's really unchanged from this $72 a barrel mark. We know we've been tracking this very closely over the past couple of weeks. If it's just consolidating sideways down here and not aggressively rallying, I think we're okay from an inflationary perspective. That's energy. Let's take a look at industrials, gap up to new record highs. That's bullish, of course. Discretionary, not new record highs, but on its way. New pivot highs up and out of this consolidation. Once again, that is bullish, of course. Let's look at technology. We were slightly concerned about technology, which had sort of led the S&P 500 daily trend change to the downside on this breakdown here underneath 228.15. Obviously, with the gap up this morning, right back up at the breakout point, I would be really really interested in a breakout of 234 to continue the upside pressure in the S&P 500. If you're looking for an excuse to long the S&P while it's near all-time highs, if you're skeptical of like, I don't know if I want to do it here, I don't know if the risk reward makes sense in the ES at all-time highs, your back pocket sort of confidence builder would be if the XLK is breaking out over 234 to target the all-time high here. That, of course, would be intraday upward pressure for the S&P, index futures if you're trading the ES, SPY options, SPX, whatever it is that you use as an instrument, right? So that's the XLK. We'll be watching that very closely. Semiconductors, not quite out of the woods. I do like the fact that there was no acceleration underneath this 245. Obviously, we have not broken back out over the 255.70. This is a top watch into the end of the week. NVIDIA, as we'll see in just a moment, is making new record highs. The rest of the semiconductors are lagging quite a bit. So watching this closely. If it consolidates, maybe we'll still give it the benefit of the doubt, but we cannot move the goalpost any further on SMH. It's sort of do or die in this range, if you will. It's either going to break or bust, one or the other, and we're watching very closely. Next up, communications. Bullish, new record highs, nothing more to say about that. Materials, gap up that faded all the way, but it is still giving an opportunity for a potential hold of 93.60. Because this is such a lightweight sector, I would only be more concerned if it was getting price acceptance underneath that 93.60. It's not so far. Here's the XLV healthcare sector, big gap up this morning. It faded almost all of it down to the 148, full gap close. Again, just like the XLB, however, this is the third heaviest weight sector, so it's different from that perspective. I would be more concerned if this starts to make more of a move underneath that 147.25, if it's getting acceptance underneath this previous pivot from back here, resistance, resistance, resistance. You can see all these different indications here and here as well for support. If we're getting acceptance below, more of a concern as of right now, feeling okay about the gap fading, and ideally it sort of holds and maybe rallies back to the upside. Be watching this one very closely. I think it could turn into a push and pull tug of war with the XLK tech sector. Let's say that tech breaks out, but healthcare sort of dribbles down a little bit lower. Tech is likely going to win that battle just as an influence for the S&P 500, but note that the push and pull is not going to make it easy per se in the S&P. It would be the strongest if the tech sector breaks out and healthcare reverses off of 148 back up towards the highs of today's session. Utilities, the most bond-like sector, sort of not immune to some of the pain that the bond market's experiencing, moving in the downward direction. Just some weak consolidation in here. It's not the end of the world, but it is a double top confirmation underneath the neckline. You're not really gapping up and over that. There was no major recovery effort here. It does look a bit weaker to me. As we know, this is D for defensive. It's also a lightweight sector. Not overly concerned with it. Let's move along to the bonds. Speaking of the TLT, just absolutely getting decimated here. And as we know, you could even look at it through the lens. You could look at notes, right? You can go over to ZN. Getting decimated over here. You could look at bonds, which, so this is the difference between the 20 is the TLT, ZN is the 10-year, the ZB is the 30-year, of course. So just getting hammered across the board on all of the different durations. Generally speaking, what this starts to imply to me, there's two different takes here. Number one is that market participants are fearful of a wave 2 inflation. So that's sort of the idea that I'm thinking about, and the sneaky little twist, that nasty sort ofness that I was talking about with the market moving into a risk-on mentality as we're breaking to record highs, is just that, you can have inflation that impacts goods that you buy every day, but you have to think about paper inflation as well, asset inflation, right? If you're not invested right now, I think that this is going to be a branching component of the market, in my opinion, where those who are invested will be rewarded through an inflationary environment. Those who are not invested, unfortunately will get left behind. And that's just the nature of the capital markets here. You could say it's good, it's bad, it's this, it's that, but that's just the reality of sort of what the market is suggesting based on both the equity prices absolutely tearing to new all-time highs and bond prices getting absolutely crushed here. So pick your own destiny. I know personally I will prefer to be invested through an inflationary environment. So that is ZB, and that is from the TLT. Let's move along to the XLP, which of course is consumer staples. And consumer staples dropping sort of down here, it's not really the end of the world. What do we know about this? It's a very lightweight sector. It's also D for defensive. I'm not concerned about it. It's got a big bearish engulfing bar here. If this was what the XLK looked like, I would be shouting from the rooftops, oh my goodness, do not trust the new all-time high that was produced in the markets. This is like a big bull trap. Oh my goodness, watch out. It's not the case. This is such a lightweight sector. It's a risk-off sector. It's defensive in terms of posture. It actually adds into the narrative that the underperformance here looks like they're selling risk-off assets to buy risk-on assets. It's a bullish rotation out of risk-off into risk-on, right? So there's that. Let's look at real estate getting hammered with 10-year rates, obviously moving in the upward direction. Not a shocker over there. Let's take a look at the ratio grid. Do we see risk on and risk off here? Yes, we do. If you're not familiar with the ratio grid, check out the video tutorial in the top right-hand corner. Generally, the XLK curling in the upward direction, huge move higher out of the XLF. You can see industrials curling higher, communications sideways, discretionary, huge move higher here. The XLV as a healthcare defensive sector moving lower. You can see consumer staples moving lower, utilities moving lower. It absolutely looks like a risk-on environment. Even looking at these ratios, we can look at some specialized ratios, and again, it's just going to ring true. Here's a huge risk-on indication. New highs here is a risk-on indication. Look at this one, just an absolute monster here to the upside on discretionary versus staples, and you can even see in semiconductors versus healthcare hanging out near those highs as well. So generally, again, I don't know how many times I have to say it in today's episode, but all of the data points do support more of this risk-on environment, and that's the main point of what we're looking at here. Here's the dollar absolutely taking off to the upside. So this is where we have to start asking some of those questions about inflation, when you have to start asking about, okay, what's the Fed going to do here on tomorrow's session? Well, the dollar's screaming. It's telling us something, right? Maybe some trade wars are in the making here. If we take a look at the ratio of gold to obviously, well, gold as a currency, but gold to the S&P 500, this continues to reiterate risk on, right? As this ratio had broken out, we were like, wow, okay, concerns, alarm bells, ding, 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 ding on today's session with gold absolutely plummeting and this ratio plummeting. It probably strikes me as being more risk on for inflationary assets like equities listed down below, right? So, to me, is this sort of is this supportive of the narrative so far? I think so. Hence the title of today's episode, hence my euphoria in the risk-on sort of ringing the alarm bell, if you will. So we talked about the dollar. We talked about gold as a currency as well. Here's interest rates. We already talked about the bonds getting blown up. Of course, that means rates are going to be moving higher. You have a technical breakout in the TNX up and over, as this is the 10-year interest rate, right? Over 4.3. There's nothing really, from a technical perspective. If you were to head all the way back to the top end of this pattern at 5%, it seems reasonable, honestly, out of the 10-year rate on a break from a technical perspective over this. If you're really zoomed out on a monthly, you could call it a bull flag or something of a pennant. So a breakout here, talking about a 5% yield, 5% interest rate on a 10-year, it's obviously going to pressure the cyclical side of the economy, but I just, based on everything I've seen so far, I think paper assets will inflate as well. So the market's trying to get ahead of some of this inflation by saying, hey, Jerome Powell, we don't care about what you're doing with cutting by 25 basis points. We're not seeing it. I think bond investors are sort of saying, hey, pay up. We need a higher yield here. And that discussion is it's sort of top of mind as we head into tomorrow's 2 o'clock, right? 2 o'clock Eastern time. Decision at 2 o'clock, press conference at 2:30 to follow. Really interested in what Jerome Powell has to say under these current circumstances, because let me tell you, it does not look favorable for him as of right now, with basically the bond market laughing in his face, saying, you want to cut, here's when the cut took place, right? Mid-September is when we had the meeting. Right around in here, Jerome Powell cuts by 50 basis points. Markets are now higher by over 50 basis points, right? I think they've rallied like 60 basis points in the 10-year. So just kind of laughing in the face of what he's done. It's, to me, sort of a sign of inflation to come. Let's take a look at the fundamental side of the market here by looking at the Fed tracker tool. So it's very likely that tomorrow's session does bring us a 25 basis point cut. Really interested in seeing whether or not Jerome Powell remains very dovish, which I think he's been quite dovish recently, or if he starts to dial it back a little bit and offers more of that hawkish side. If you keep in mind that the SEP Summary of Economic Projections forecast for the Fed funds rate is at a 4.4, we are technically on pace to get there for the end of the year if we see a 25 basis point cut in the month of December here. So, as of right now, it looks likely, but once again, we probably don't want the markets pricing in much more than that. One of the things that you'll have noticed over the past couple of sessions is that this terminal rate down here actually has shifted higher. We were pricing in something like 350 to 375. Now it's sort of at 375 to 400, and this flies in the face of what the longer run rate expectation is here, working its way down towards like 2.9. Obviously, the TNX and the bond market disagrees with this projection anyhow, so we'll see if there are any updates on that. One of the things we should pay attention to as well is the inflation projections here. By the end of 24, we were looking at 2.3 on the non-core PCE and a 2.6 on the core PCE. Obviously, we're not getting a new SEP tomorrow, but keep in mind that these sort of targets have been achieved at least on the PCE front. So Jerome Powell, I don't know that he has an excuse to lower rates aggressively or be even more dovish if the labor market has not really changed, right? The labor market unemployment rate, as we just got, what was it, last Friday, was at a 4.1. You're looking at a projection out of a 4.4. We're not even close, right? We're even underneath the longer run expectation here. So I do think that there's some wiggle room to sort of keep rates, I wouldn't say higher for longer, but generally speaking, I think there's some room for Jerome Powell to express a little bit more of that cautious stance and sort of acknowledge what's happening in the bond market. Here we go with the calendar in terms of what's going on. It was a pretty quiet day in terms of new news that we got. Nothing crazy here. I actually did not look at the breakdown of ISM Services PMI. That's probably something we should do. Maybe I'll post a graphic of that now. So there it is on the screen. And what else do we have tomorrow? Unemployment claims, that's the usual, and it's really just the Fed. The Fed is the name of the game for the end of the week. I've already given you my thoughts on that. If we are going to talk about the election results, obviously, let's just, show this. This is the state of the affairs as of right now. Obviously, we have a declared winner, but I'm not just bringing this up for the sake of bringing it up. I want to tie it into the seasonality of election years, right? If you look at elections, it doesn't matter who wins, who you thought should have won, X, Y, Z, whatever. All that matters is after the election, so much volatility gets sucked out of the market that the crush in volatility actually allows the market to sort of breathe out a sigh of relief, and typically that's expressed as an upside move, right? If you're dealing with, and we're sort of segueing a little bit ahead of schedule into volatility here, but I can just bring it up because I think that the timing is suited. If we look at VIX futures, right? Generally speaking, what you see here is the expression of backwardation. You have more risk in the present day than you do at some point in the unknown future. So put yourself in the shoes of a money manager. Why would you invest today when you could wait for less volatility in the future? Right? That's basically the premise of looking at backwardation and contango here. And what happens after the election? Well, none other than a straight shot right back to the zero line. And I wouldn't be shocked if after the FOMC tomorrow, you get a little bit more towards the contango, which would be up and over the zero mark. For those who are unaware of this, this is just a subtraction between the front and back month of volatility futures. You could do the same thing here with the 9 versus 30-day VIX. And this is just a one-day VIX in isolation. So for anybody who's been scratching their head about like why we look at this thing every single week, and every single midweek video as well, that's exactly the reason why. As you get back towards positive territory, it's easier for the broad market to trend in the upward direction. Let's get back on over here just so we can acknowledge the earnings calendar. Today, after the close, it was ARM and Qualcomm for the semiconductor space. Tomorrow, a lot of honorable mentions after the close here. Some of the ones that I'm mostly interested in are actually down towards the bottom. We have Airbnb, just to see what's going on with the state of the consumer, how are bookings doing, what's going on with those rental properties. Is there going to be the big implosion like they were already talking about in Florida of those coastal properties? Is there going to be an Airbnb implosion, or is it just sort of doing fine? Are bookings doing fine? That'll be a big tell. That's tomorrow after the close. Nothing to pay attention to on Friday before the open. Let's get back on over to the platform here. We'll take a look through some additional risk on versus risk off indications, starting with the TLT ratio to the S&P, getting absolutely crushed. No surprises over there. That's risk on. If we take a look at credit spreads, I know we skipped bonds. We'll go back to that in a second. These are moving in the downward direction. Again, this is more of a comfortable risk on look. This would indicate the sort of, what would you say? This would indicate volatility getting sucked out of the market, basically. Let's go back to bonds in relationship to themselves because I don't want to try to hide any of the data points. That was not the point. It was a misclick. Promise you that. These moving in the upward direction continue to signal that fear about inflation, basically. And that's kind of my take here, which is that the market's rallying. It is a risk-on environment, but it's an inflationary risk-on environment where paper assets will inflate as well. I think that I've sort of vocalized that thesis a little bit. I'd love to hear your opinions down below in the comments section. Am I crazy for forecasting this? Do you agree? Do you think it's going to be inflationary, but oh my goodness, employment's going to spiral out of control, unemployment, I should say, and we're going to fall into a stagflationary environment? Like, what are your thoughts? Let me know down below in the comments. I'd love to hear from you guys. Let's go ahead and take a look at the HYG in isolation. Still not quite sure of the breakout here with the lower high that persists, even with the higher high happening in equities. You could say the same thing with the LQD. And once again, this is just sort of in line with the bond market imploding just a little bit. If we take a look at the Bitcoin chart, this is absolutely breaking to new highs here over the handle highs, which is bullish. And again, more of a risk on sentiment. The Sailor Shift tool is also firing that bullish signal as well. Let's take a look at the total breadth. This has just absolutely rebounded in a beautiful way off the zero line to make new highs out of new highs versus lows. That, of course, signals more of a breadth thrust. You're seeing a strong move here out of the 50-day. back up towards, or I should say off of the 50% mark, 50-day moving average, moving away from the 50% mark, back up towards here. So all set from a breadth perspective. The RSP would confirm this with the gap up to new record highs in the equal weight index as well. If we take a look at the equal weight NASDAQ, same idea, new gap up happening over here. We could take a look at the Dow versus the transports, because I did not look at this, but my goodness, whoa, the prayers have been answered. How long has this been divergent for? This is more so like our IWM indication, where small caps, those risk-on sort of looks, are springing back to life. So a huge move higher out of Dow Jones Transports down here in the lower pane, confirming the break to new record highs in industrials up above. Love that. Awesome confluence of what we're seeing. VIX volatility getting crushed, not a shock considering everything we've looked at so far and what we've discussed based on the election being in the rearview mirror. We have VVIX moving to the downside as well, and we've already looked at this, but we'll just bring it up one more time. Volatility is getting crushed. Let's take a look through the core list of companies, and we'll get you on your way here for a Wednesday afternoon video. What do we see here? So here's a balance range breaking down lower high. Apple is honestly one of the laggards, I would say, of today's big move. It did not open on a gap up. It attempted to break back up into this balance range overhead, but look at how it closed. Really weak, a rejection of the daily 50 SMA. Apple's not really feeling the love here on the big gap up and the risk on rotation that we're seeing right now. So as long as price is underneath 223.75, I would just be looking for downside rotations into this support zone down below. That's 217.25 down to 214. If it is going to act bullish, again, let's just take a look at the intraday chart here. There was one heck of an opportunity. I was actually looking for a long intraday off of 223.75. Thank goodness we went with Microsoft instead. But generally, the idea was left, head, right. There's a break of the neckline, right? No dice on the higher low pullback above, and instead we close underneath. As we can see, Apple is looking weaker here underneath that key level, 223.75, and that is that. Let's move along to Microsoft. Speaking of, a much stronger looking chart with equal lows happening here and finally breaking into the gap overhead. Looking for continuation to the upside. Ultimately, we do have the moving averages tangled up right here towards the high of day, but the target is the gap close at 432. If we can do it, awesome. When we get there, looking for a mild pullback, higher low, and continuation over time. If the market just consolidates here, ideally, it stays up and over, not 416.25, that would be great, but the line in the sand I would use is 414.75. Here it is on the hourly time frame chart. You can clearly see it as the intraday pullback low happening here, as well as the highs and the highs from these two sessions back here and over here as well. So consolidation remains bullish, looking for this over time. When we get here, be mindful of a pullback. If we start to collapse underneath 414.75, call it for what it is. It's a look above into the gap, mind you, and fail. And you could even go so far as saying, hey, if it happens like this, there's just a double top. 1 and 2 under the neckline gets dangerous, right? That's Microsoft. Let's take a look at NVDA. The one stock to rule them all goes on to produce brand new record highs on today's session with the broad market gapping up. Love to see that. We have just a very straightforward chart. No need to overcomplicate this. As a matter of fact, we'll just drop it down to the hourly because that's really all we need, right? You can go consolidation here, blue sky breakout, pullback that holds the gap, Brigade bolt back over the all-time highs trade. I would not really be bearish in NVIDIA unless something like this happens, honestly. It would really have to be a move underneath 137.25. Think about it through the lens of this was a balance range. Sellers had their opportunity here. They absolutely failed. So therefore, if the daily chart produces lows and higher lows, you're good to go from a trend reversal perspective coming in from the highest high in the trend count. 137.25 will still act as that key inflection point. Let's move along to Google. This has been a swing trader's dream, so shout out to anybody who's been swing trading Google. You can see this massive inverted head and shoulders, the professional gap up on earnings, closed the other earnings gap, and now we have another gap over here, so it's getting a little bit Swiss cheesy. But as of right now, I would just be looking for consolidation in the zone. Brigade bolts retrace this thin structure from the earnings fade. That's awesome. That's over 176.25. And if it moves into the gap, that's fine. Looking for a gap close, honestly. And I would honestly, not to overuse the word honestly, catch myself as that happens every now and then. I would be open-minded to, because this, if this takes place, right, something that looks like this, I'd be open-minded to saying, hey, possible lower high, if this comes back in for another test of 169, is it possible that we could see a range rotation back down to the right shoulder low at 161.50? It's definitely in the cards. It is in the cards. I would not sort of count that out as a possibility. But for now, definitely leaning more so on the bull side, saying consolidation, Brigade bolts, thin structure retracement from the earnings gap up. 181.50 is the major target. Next up, Amazon breaking to record highs on today's session. Jeff Bezos putting out a very interesting tweet considering his history with politics, but seems as though, he's just relishing in the fact that, hey, new record highs means he's just another billion richer, right? So anyhow, break the new record highs means this. All set. All set. The only time to be concerned is probably something that looks like this, with acceptance back inside of this range. I would honestly say that gap fill reversal, not to again use that word, something that looks like that, all set. No issues out of Amazon. Chart looks bullish. Happy to be long in the long-term account and even find some opportunities intraday. Next up, Metaverse. What do we see? Look below and fail. Again, round 2. Taking it on down immediately to the hourly chart because I think this is where the story is the clearest. You had look below and fail here, so rotation to the top end was fairly straightforward. Today's open was kind of interesting with the remainder of the broad market opening on the gap up. So another look below and fail, undercut the 50 SMA and close back at the top end of this balance range. I think that the squeeze is on through a thin structure retracement over 574 into 584, 10 points available for a range double out of Meta in the upward direction. Love this trade. I'm very interested in that into the end of the week. That will be a top watch. Next up, we have Tesla. What's going on with Mr. Musk? You can almost say it's, just as much his victory as it is the president-elect, the way that guy's been involved. But what do we see from a chart perspective? You certainly have a little bit of a Swiss cheese chart here. You've got a gap up, you've got a gap up happening here. I mean, this was a gap down to indicate the island reversal. So all over the place out of the technical levels. One of the things that we can say about this, just like the broad market, is that the lower wick implies a pullback. It implies that sellers tried to get active there, but where did they go? They really didn't go much further than the previous pivot highs, and then obviously we rallied to close at the high of the day. So generally speaking, consolidation, looking for new intraday levels to form, and then looking for continuation because the bulls are in control. We have 296.50, 312, and 332.25 as upper targets. If it gets into the gap, be my guest if you want to fade it through there. I would still be in the mindset of looking for a higher low off the gap fill reversals like 255.50, or heck, even if it comes back in for a test of 239, 234.15, which as we all know is left head, right shoulder. There's your inverted head and shoulders that broke. That same level is still in play. 239, 234.15 as a zone. Next up, we have JP Morgan, another one that just speaks for itself. Financial sector absolutely on fire here. Big gap up, big follow through to the upside. Very rare that you see JP Morgan up 5.13% in a day. Incredible. Absolutely incredible. So blue sky territory is nothing to really comment on. I would not say this is a top watch for trades. You might get day 2 continuation, but do I have levels? Do I have structure for you? No, just use your prior day's high. If you're out of range with a higher low, great, looking for longs. If you're in range, just sort of neutral until you get a clean setup in the upward direction. Next up, Netflix, the mind of its own rally could potentially be underway. You know that after earnings, it did the dance for a little while, finally got back off to the races. After earnings, it did the dance for a little while, new record highs with, again, a very euphoric market sort of behind it right now. Generally, any holds outside of 772, it's got to be further upside. That's my take, at least out of Netflix, looking for it to do the dance like it has done so many times before. Balance, dance, right? You can see up here, balance, continuation. So Netflix, let's see if it can do it again. Round 4. Moving along to AMD, this is a great example of why you never pick the laggard in the specific industry that you are trading. NVIDIA is the name of the game. AMD was catching up, and it was, it was playing nicely when it was just semiconductors were all on fire. But now that some of the winners are separating from the pack and you have some laggards as well, AMD clearly falls into that laggard camp, not even able to produce a meaningful counter trend move off of a 15% fall from the earnings announcement. Just absolutely brutal for anybody trying to long AMD. Again, I think this is a clear example and a lesson in terms of picking and sticking with the market leaders in that space. So if it breaks over 145.75, I'm not saying that AMD is like dead and gone. We can never touch this thing again. But, it just stick with the leaders, stick with where there's interest. Just look at the amount of volume that transacts through NVIDIA versus AMD, and they're quite literally trading almost at the same price point. Right? Just that should tell you all you need to know about the chart. So if it breaks over 145.75, great. We have this gap to close overhead. If we're just consolidating down here, call it for what it is, bear flag, and over time, if the laggard's going to lag, you're looking for downside, looking for some of these lower targets as well. So something like under 142 trades 137.75 and 132.50. I promised you I had one additional trade idea for you, and it's going to be on Uber, UBER. Let's take a look. What do we see out of Uber, and why is it interesting? Daily time frame chart produces a massive hammer candle that looks underneath a 3-day balance range low, looks underneath the daily 200 SMA. It does not make a new lower low relative to the earnings gap down low, but it does make an equal high, and it closes at that equal high relative to this entire little segment of price action. So what does it mean? Anything that looks like this is a thin structure retracement overhead through the earnings gap, looking to close it. So 74.50 into 77.75 is the idea. Could you call it a double bottom? I mean, maybe. Maybe it looks something like that. Maybe you could call it vampire teeth. That may be a little bit more appropriate, although a bit late considering the flip of the calendar to November from October, but you get the idea. Over 74.50, 77.75, thin structure retracement, looking for this. If the sellers were going to make it happen again, just put yourself in the shoes of the opposite side of the trade. This is the most important and powerful thing to do in trading. If you want to try to long something, think about what your counterparty is doing. If you're a seller here, what would you have wanted to see off of this morning's open? You have a 3-day balance range here. You make new 3-day lows. This is what you want to see. Continuation to the downside. Lower high stays underneath this balance range right here. Does that take place? The answer is absolutely not. Shorts should be shaking in their boots. If they haven't stopped out already, it's very likely that a stop run takes place over that flat top, 74.50. This is the way I like to think about markets. Hopefully that helps you as a framework for you to think about markets, and hopefully it improves your trading. That's all I've got for you on today's episode of the Midweek Market Update. If you enjoyed the video, if you learned anything new, or if you're excited by this risk-on breakout in the market to new record highs in the S&P 500 and the NASDAQ 100, let me know down below in the comments section. Let me know what you guys think of this move. I'm also curious about your thoughts on the inflation versus stagflation versus asset inflation, the whole 9 yards of our conversation earlier. So with that, a thumbs up goes a long way. I'll talk to you guys in the comments section, and hopefully I'll see you tomorrow for the pre-market prep kicking off at 8 a.m. Eastern. We'll take a look through the market in the morning, see how things are setting up, and then we'll be live again at 1:45 Eastern time. 1:45 Eastern time, about 15 minutes before the Fed decision, and then we'll stay live for the first little bits of Jerome Powell's press conference at 2:30. All right, so tap into the afternoon live stream as well if you're interested in seeing the live market reaction to the FOMC event. With that said, have a green trading week, and I will see you in the next one.